For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade and I'm just here to ask the question, of course, but you know the words of wisdom and solid advice. They come from Randy and Jake Floyd of Floyd Financial Group. Randy, how you doing this fine Saturday morning?
Doing very well, Jeff. How about you?
I'm doing great, thank you. Hey, Jake, how's the Saturday morning treating you, my friend?
I'm doing great, Jeff. Thanks for asking.
Certainly glad to hear that, you guys. Hope everybody listening to us is having a great Saturday so far. We've got another great show lined up for us today, of course, filled with information for your fiscal fitness and your financial education. And as always, gentlemen, let's dive into what's going on in current events today. I understand that corporate earnings are coming out pretty soon. Have we had some corporate earnings released so far? And when do you think that we're going to be having the rest of those? Or basically, what do we think that they're going to be? I know this is a guess.
Yeah, so I mean, we've had some mixed earnings out there, but I will say that we've had some pretty good results, and we've had some that barely missed. The thing that's kind of interesting is there's a high punishment level for those that miss right now, and not as much of a reward as you would think for those that have done well is kind of the thing that's shaking out, which kind of tells us the overall advisor sentiment right now as to what they're seeing, who obviously at some point does, represent what the public is thinking as well. But we think that, we're in the middle of earnings season. We got a long way to go yet, but I am encouraged by what I'm seeing on, what I would call the big core companies.
Yeah, I also think, Randy, that we're still fairly early in this whole cycle of earnings, and I think that it's likely that as earnings season goes on, I think the earnings will continue to be maybe better than expected or in line with what's expected. But I do think that it shows a shift in sentiment, like you were saying, whereas 3 or 4 months ago when we had earnings, it was the other way, where they were kind of mediocre earnings, and just because they weren't bad, the market was going up. And so it shows that we may not be done with this little correction that we're having. It's hard to say at this point, but looking forward to the rest of the year, at some point we're going to continue to have a pullback as we go into the election. Again, as we talked about before on this show, we think after the election things are going to be looking up quite a bit, potentially even regardless of who gets in office. So definitely interesting times we're living in.
One additional thing, Jake, that was kind of interesting, UPS, they actually beat their earnings, but they missed on their revenue side. And this is something we've been seeing. In fact, talking with some people from some trucking companies, nationally, trucking industry is having kind of a hard time right now. And that's due to the fact that I believe that, and we've talked about this before, due to inflation and the inflationary pressures and companies really trying to bolster their profits, unit volume is probably down. But the fact that they're charging so much more for the units being sold and the profitability dropping to the bottom line, it's a really interesting time.
And typically in a market that really wants to run, it's the opposite, right? Where you have revenue that's blowing it out of the water. Maybe they're not making money, but people will assume that's coming at some point. I agree with that, Randy. I think that a lot of this is just prices. We know inflation is much higher than what really the government's been telling us. They say it's up 15% over 3 years. I think that's laughable. Prices are up way more than that. So I do think that we're seeing that in the numbers. It's probably time to be a little bit cautious, not too cautious, but a little bit cautious, and then as the year unfolds here, we'll find a time to become more aggressive again.
So inflation, as reported right now, I think is right about 3%. You're saying that it's actually more than that. What do you think it's going to take here to tame inflation? I mean, we've been waiting for this recession and inflation to go down for, I don't know, it's been quite a few days, like 450 to 500 days. What do you think it's going to take to tame all this finally?
So one of two things has to happen to fix this problem. Either people have to run out of the ability to pay for this stuff, or they have to stop wanting to pay for this stuff. I think you and I both know that people's appetite for stuff is pretty well insatiable. So it's going to take unemployment rising, in my opinion, and people losing their jobs to stop this inflation. I'm not sure that anything the Fed can do is really going to affect that in the short term unless they were just really bring interest rates up a lot, which they're not really looking at this point.
And that brings us to the topic of interest rates. I mean, at this point in time, as you said, in the beginning of the year, we were expecting 3 to 4 rate cuts. Right now, does it look like that we're going to have any, do you think?
Well, I think the prognosis still is that we maybe have, one by year end. Of course, everything, as Jerome would say, is data dependent, right? And so, the only question I have about that is how dependent or dependable is that data?
Coming out of the Biden administration, I don't think I need to comment on that.
Yeah. I think we know where you stand on that one, Jake. Talk with Randy and Jake of Floyd Financial Group about current events. So that's what's happening with corporate earnings. Let's shift to artificial intelligence, which is certainly not a fad. It's not going away. It's just growing by leaps and bounds. Is it or is it not?
Actually, I have to run back for 2 seconds, Jeff, because I can't help it. So, as far as the Biden administration is concerned, all the data that has been coming out about how good markets are, how good trade is, how inflation's going down, what happens is that data comes out and then it gets revised in future months. And so he's been putting out numbers that say, hey, inflation is lower than expected. And then after everybody's forgotten about that number and they moved on to the next one, he revises it up to the real number. And he's been doing that for like 2 years now on all these different metrics where it's like, hey, we're going to put out this number that's BS, frankly, and then we'll revise it later to the real number. And so we know he's been doing that. We know he's been lying about those numbers, and his administration has been putting out this stuff trying to make him look good ahead of the next election. So it's not a matter of whether he will distort those numbers, it's how much and to whose end. But moving on to your artificial intelligence question, I do think that AI is still in the driver's seat. I think that AI will continue to be in the driver's seat. Whether or not that's a good thing really depends on whether you're investing money or living your life. If you're investing money, it does give you a theme to invest in. However, if artificial intelligence doesn't scare you, you're probably not paying attention.
I think it's interesting too, Jake. I was listening to an interview early this morning, and there's a guy on there that's got a private company, and I can't believe that I can't think of the name of the company now, but the guy talked for quite some time, and he was talking about how his company is really pioneering making AI and this artificial intelligence, making it intelligent. Because right now it's kind of dumber than a box of rocks, right?
Right.
So what he's talking about is the fact that they will have to figure out how to accelerate the input of data into the machine so that the machine can have a basis from which to draw to learn.
That reminds me of that John Travolta movie where he says, "Any word from the LAPD intelligence, if there is such a thing."
So
I think that was on Face Off, I think is what it was.
Yeah.
Go ahead. Sorry, I didn't mean to interrupt you, but that really reminded me of that.
I thought that was an interesting question or an interesting stance and interesting thought process that he had there, because it's true. We know now that, in fact, I don't know if you've watched if you go out and look at any subject today on YouTube, you just go out and type it in.
Right.
Half of that stuff out there is AI generated. And the reason I know is when it comes to a word like person, it'll say person, or some word that we would normally say totally differently. It will enunciate it in such a way that you're like, well, that's a computer, obviously. And so for AI to actually become AI, it's got a lot of learning to do.
It's artificial, but is it intelligent? I don't know.
Do you think artificial intelligence, AI, has the ability to basically change the world? I mean, that's what I think of when I think of artificial intelligence, is these computers taking over, just thinking for Americans. I mean, what do you think about that?
I think not only does it have the ability, it is a virtual certainty that this will take over everything. It will shape the laws of our nation for the next 20 to 30 years. Laws like copyrights and infringement thereof are going to be blown out of the water because it'll be unpoliceable. They will have to, at some point, come up with some kind of a digital watermark for these AIs that are operating legitimately so that you can tell the difference between artificial intelligence and not. Because if they don't do that, it's going to be very difficult to punish those who are plagiarizing and or stealing intellectual property. It's going to be a very tricky thing to do, especially in the early days of AI. It's going to be mainly around words, information, that kind of thing. I'm not too worried about the Terminator type AI just yet. I do think that may be something to worry about in the future. I do think, though, in the short term, though, it's going to really change the way that we use and interact with information. And AI will have an abnormally large influence and direction influence on our country as it gets involved in TikTok and things like that, where it shows, 13-year-old girls more about being depressed and eating disorders and things like that. There's huge negatives there, right? There's a few positives. I think the negatives far outweigh the positives, as it does with social media and other things. Is social media good? There's a few things it's good for, but there's a whole lot it's awful for. And I think disinventing social media might be the greatest thing we could ever do. Unfortunately, you can't do that. Or cell phones, right? There's certainly smartphones, where we're connected 24 hours a day, 7 days a week, constantly. There's a reason everybody feels tired and spent. It's because they never turn it off.
You're right.
And,
right.
Anyway, that was a little bit of a rant there, but I do think, yes, to answer your question more simply, I think it's going to change everything.
Yeah, well, I think people on a regular basis should take a break from social media and their cell phones. Try it for a week and see how you feel. I'm sorry, I think, Randy, you were going to say something?
Yeah, I was just going to say we have to remember the soothsayer and the great prognosticator, Zager and Evans, in their song in 1969, in the year 2525, your arms are hanging limp at your side. Your legs got nothing to do. Some machine doing that for you.
I'd love that you always bring up these references, Randy, that I've long forgotten about. But you're right, Zager and Evans in the year 2025. Talking with Randy and Jake of Floyd Financial Group, let's talk about cryptocurrency. What's happening in that market?
So cryptocurrency has been on a big tear right now, and I do think that crypto is definitely here to stay, and I don't want to give any implication that it's not. Especially cryptocurrencies other than Bitcoin and Ether. Those other currencies are really just kind of fake currencies for the most part. There's a few implications of some of the other ones, and I don't want to get into the nitty-gritty here, but let's just say that as people are investing in some of these cryptocurrencies, they just need to realize it's akin to gambling. It's like going down here to downstream and putting a $100 bill in the slot machine. As long as you realize that you're gambling, I guess that's fine if you want to invest there, but it's really not investing in the traditional sense, in my opinion. I have a lot of people ask me about cryptocurrency, and I guess that's natural when you have something that's up, however many million % over the last decade, and even over the last 6 months. Even Bitcoin's up 300-400%. I do think that we're probably coming close to a temporary top here because everybody's starting to get on board. Everybody's starting to get excited. Any market, any asset class, when you have everybody getting excited about it, then that means you've just about run out of buyers because everybody who's going to buy is bought. So usually if you want to buy low and sell high, you want to buy when everybody's negative and you want to sell when everybody's positive. So I would say that on the grand scale there, I think we're much closer to everybody being positive on crypto right now than we are everybody being negative. And so I would just say, if you're into crypto, I'd be a little careful here. If you're in it for the long haul, you may do okay. And I certainly think that crypto could go higher, but I'll promise you it can also go lower.
So what about this split we're having? Isn't this like this halving of crypto? Isn't this kind of like a stock split?
Not really. So what's happening here is we're nearing the end of the Bitcoin mining phase, right? I'm trying to remember the exact number, but I think it's over 90% of all the Bitcoins that will ever exist already exist. And so the halving really makes it considerably more expensive for Bitcoin miners to mine Bitcoin. And therefore there will be less production. Less production equals less supply equals higher price in theory. That's part of the reason why that's been running up into this. And so I think after this happens, it would not shock me at all to see it get cut down quite a lot. I don't like to speculate on speculation because even if you're right, you can still be wrong in the short term. Bitcoin and Ether and maybe Cardano, maybe Solana, maybe XRP are here to stay, but the other 2,000 or 3,000 coins that are out there trading are just somebody pump and dumping you. And again, that doesn't mean you can't make money. You can still make money, but you just need to understand that somebody is out to get you, and they will devour you if they can.
But one thing I want to throw in here, too, that I think maybe needs to be explained, and maybe not, but I'm just going to venture out here and say Bitcoin doesn't make anything. It doesn't produce anything. It doesn't pay a dividend.
Neither does gold.
That's right. And that's my point exactly. And so we know that the problem with gold is what? Gold is valuable, yes, and it's at all-time highs right now. But if you compare it to a business, something that produces goods and services that people buy and rebuy and use, it's just a different story. Now you've got something, it's not gambling. You actually have a business, something that's got value other than, hey, I think that's pretty cool, I want some of it.
So this is an argument that Warren Buffett has been making for 60 years or more about gold. And really, Bitcoin is no different than gold from an asset standpoint. Some people would argue it is because it's tangible. But ultimately, gold is a shiny metal that we've decided has value. Bitcoin is a digital currency that we've decided has value. It's really no different. Honestly, it's really no different than cash. Cash has value because we've decided that it does. And I don't want to burst anybody's bubble here, but it's all pretty fragile. It's all pretty dependent on the house of cards, if you will. Like you said, I'm not a big fan of Warren Buffett's politics. But as an investor, he's very hard to argue with. And, he has a lot of sayings out there, but one of them is that he doesn't like gold because it doesn't produce anything. He doesn't have any problem with gold, the metal, but he would say similar things about cryptocurrency. And I agree with you 100%, Randy. I think productivity is what drives us forward as an economic force. And so if you're not producing something, it will eventually fall by the wayside, at least temporarily. It may come back later, like gold has over the years. It's fallen away and come back and fallen away and come back. But if it doesn't produce something, it's going to be hard to justify having it long term.
We're talking with Randy and Jake of Floyd Financial Group, and of course our show is called Show Me the Money. My name is Jeff Shade, and we have just finished discussing current events, not the least of which has been cryptocurrency. And again, if you'd like to sit down with Randy and Jake and have an individual conversation and maybe ask the questions that you want answered to determine whether or not you're on a path towards a confident retirement, as we do every week, we're offering this no cost, no obligation, and no judgment retirement review with Floyd Financial Group and Randy and Jake. To get yours, call 417-889-7233, 417-889-7233. Once again, no cost, no obligation for that. It's just a casual conversation with you and Randy and or Jake at Floyd Financial Group, as I said, to get some questions answered that you need to have answered to put you on a path towards prosperous retirement. Once again, call that number. You can do it this weekend if you want, 417-889-7233. Leave your name, your telephone number. Ashley will give you a call back during the week and set you up with an appointment with Randy and Jake. You can also find out more about our firm online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Gentlemen, we're going to take a break here. When we come back, we'll be talking about 12 ways that you can screw up your retirement and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about 12 ways that you could possibly mess up your retirement savings.
That's right. I think there are probably more than 12, Randy and Jake, but we're going to narrow it down to 12 here. So let's begin with the first one here, I think, which is pretty basic. A lot of people just throw up their hands and go, I'm going to give up. I can't save anything at all. But I think that's a big mistake, is not even bothering to try to save.
Yeah, it really is. And I would say this, Jeff, it's not those people's fault that they feel that way. If you think about how we have taught our kids and normally how we teach them to save money and invest money, or how to look at money in general, we don't do a very good job of that, except for the fact that this is what money will buy. That's really
Right.
about all that we do. And then we have right now in the country kind of an apathetic vibe, if you will, especially through the youngsters, thinking, woe is me, we can't do anything. So I think that we need to work on that mindset a little bit, but certainly starting to save and watching that money start to grow, and then having a little bit over there and having some skin in the game and something to lose will make you think about saving and even saving more. So I think it's something we definitely need to encourage people to do at some level. There's a lot of different takes on how to go about that, but I would tell people, if you get a raise, but that's a really good time to start saving some money.
Sure.
Don't just put all that money into your budget by buying a new car or buying a new widget. Jake loves it when I talk about widgets, and so
Sure.
I wanted to throw that in there today. Get a new widget that costs you your raise, right?
I always visualize what a widget is. I think it has pointy corners and so forth. But yeah, I know what you're talking about. I've got a grandnephew who is now 19 turning 20, and he's become a welder. He decided to go to trade school. He's got a job making some very, very good money. And at this age, his father is setting him up so that he has automatic savings that goes into a retirement account. Now, he's 19, going on 20, and he lives at home. Should somebody that young start saving for retirement, or do you think maybe they should be saving for something else, such as a first home? I mean, when is it appropriate to begin to save for retirement?
Well, first of all, I think when you start saving is a good thing, and everybody should be taught to do that. And then the good news is that you start to save whatever comes up in the future, whether it's furthering your education, getting married, buying your first home, whatever it is. It's never a bad idea to have some extra money laying around just in case.
I think saving for both is the right answer, especially as you first start making money is the best time to do it because you're not used to having the money.
Right.
This is one of the reasons why a lot of people, when they get a raise, they put their raise into their 401k because they're not used to having the money. So if they don't get used to having it, they can just up their contribution and pretty soon they have a whole bunch of money in their 401k. I think that's a very good way to go about it. You don't have to put all your raise in there, but put some of your raise in there when you get a raise. But if you set it up to where it comes out before you even see it, your chances of success are probably 10 times that of if you put it in your bank account and you think, well, I'll put it over there at some point.
Yeah, and he's going to be using the eighth wonder of the world as well, too, which is compounded interest. But I think that on one level, it's exactly right to begin the habit of saving. But of course, as you said, it's coming out without him ever seeing it. But I don't know about retirement at age 20 when he doesn't have a house yet. So I don't know. You know, he's living at home because he likes to live. But basically, his parents want him to live at home because he can ferry around his 13-year-old sister who, obviously doesn't drive. So not bothering to save is our first thing that you can do that will derail your retirement. Second one is figuring that you don't need to save because you're never going to retire.
I understand that mentality a little bit because as I was going through life, and I once told my wife one time when we were first married, I said, once a person resolves themselves to the fact that you're going to need to occupy your time and do something and make a living, then let's go out and get that deal done, right? Let's go do it, and then let's try to make as much of that as we can. If we have to spend our time anyway, we may as well make as much money as we can while we're doing it, right? So make sure that we're doing what's right and working hard and saving, and then is a part of that at some point. Now, early on, if you aren't careful when you're first married and you're out there, you're buying a house and you're buying maybe a new car and all those things, you're having your first child and you're having to furnish your house and all those different things, it's very easy not to save and not to start the process, which does make it look pretty dismal. But everybody should go through the exercise of sitting down and saying, hey, if I save, start with any number you want to, $100 a month, every month at a 6%, which would be a relatively low investment return, and see what your money looks like after that's compounded over 25 or 30 or 40 years. Then all of a sudden, the thing that they will do next is they'll say, well, what would happen if I did $200 a month? Pretty soon they're looking at these numbers, they're going, wow, I do now see how the compound interest effect can really get me to where I can retire.
Especially at 20 years old.
Yeah.
Because let's figure you make 7%. Rule of 72 says my money doubles roughly every 10 years. If you save for 30 years versus 40 years versus 50 years, that's an extra doubling and then a quadrupling with that extra 20 years, right? So like if you wait till you're 40, you're going to have a quarter as much money as if you start when you're 20. I have these little things I think about sometimes. So like when you go to Starbucks and you spend $5 or $6 on that cup of coffee, if you're 65, it's one thing. If you're 18, that $6 that you put on that cup of coffee, had you saved it instead, probably costs you $100. Now, maybe that coffee is worth $100 to you, but maybe it's not.
No. We were talking earlier about the coffee. It's not worth it for me. I'm not a coffee connoisseur. I don't need Starbucks, but a lot of people think that they do.
Well, black coffee is quite a bit cheaper than the designer type coffee, right?
Yeah.
Even in today's world, you can get a pretty great cup of coffee for $2.50, $3. versus spending 6 on, so maybe you just save the difference, right? Go to black coffee, get your antioxidants,
there you
be
go.
Healthy, and save money.
Well, as I said, I'm not a coffee connoisseur. I mean, I lived in Seattle for a while where it's a food group and it's really dark and bitter and everything, but I prefer gas station coffee. I mean, I got to tell you, it's like $1 or so. It does the job, but I know what you're talking about. The subject here, though, was figuring that you don't need to save because you're never going to retire. Well, think about this. That may be your goal, but you may not be able to work because physically or mentally you're not going to be able to work. So it's a great goal to have, but don't count on it and continue to save anyway. Next one on the list is underestimating your needs as one of the ways that you can mess up your retirement big time.
Yeah, for sure. I mean, a lot of people used to think that Social Security is all they would need to retire. Sometimes, especially when people are younger and they haven't really thought it through and really looked at what it's going to cost, it's easy to get complacent, I guess, and to think, well, I'll worry about that later or sometime in the future. And pretty soon the future is here. And so we want to make sure that we don't, thou shalt not kid thyself, right? I mean,
Yeah, I like that
so
one.
you probably need to go out and really look at, think of it this way, if you're 20 today, and when you retire, you're 60, that's 40 years. Think about this way, at a 3% compound to double, like Jake had said, extrapolate those numbers out. 3% inflation every 24 years, it takes twice as much money. So when you start looking at that, think about what your current salary is and how you're living versus how you might want to live now. You may say, well, I'd like to double what my current lifestyle is. Well, go ahead and double that number today and then go out there and take it times quadruple and a half, or 6 times really is what we're talking about, to know what it's going to be equal probably in spending money. And let's face it, I'm going to tell you, from a guy that has reached retirement age, I don't really want to spend any less money than I spent when I was working. In fact,
No.
I might want to spend a little bit more.
That's right. You're doing some traveling. You got some expensive bicycles, but you've worked hard for that too. But I think underestimating your needs can be a big problem because think about this. I mean, if the average Social Security check's around $1,900, I mean, that's less than $24,000 a year. Do you think you can live on $24,000 a year? Certainly you're not going to. And as far as longevity goes too, if you're 65 today and you're in relatively good health, you got a pretty good chance to living to age 90. So, I mean, you've got to support yourself without a regular paycheck all the way into your 90s, and that could be 25, 30 years. So don't underestimate your needs in retirement. Our next one is not automating your savings through payroll deductions. Now, that is a way that you can really mess up your retirement. We touched on it earlier. If you don't see it, you're not going to miss it.
Yeah, that's for sure. I remember early on in my career when the 401k was, a lot of people don't realize the 401k hasn't always been. The Employee Retirement Income Security Act of 1974, ERISA, which is what started the IRAs and 401ks as we know them, really didn't catch hold and really start to permeate business until the mid-'80s in a big way. So I'm already in my career. I'm in 85. I'm 28 years old. And I've got a 401k plan, and, we looked at the stock market, and the stock market, has its ups and downs, and my wife says, I don't think we want to put any money over there. And I said, but honey, they'll match me up to 6%. She said, I don't care. I don't think we want to put any money over there. But finally, she got to the point to where we looked at it and we thought, you know what? If they're going to give us what we put in, we're never going to lose it all, especially if we do smart investing with large companies in the S&P 500, the Dow, and those companies. And looking back historically how the market had always grown, it just made sense to get that free money and let that money compound for you. And by doing it automated, it automatically, when you get a raise, it automatically ups your contribution. Also, if you get a pretty good size raise, you may want to up that contribution even more than what they will match, just to avoid some taxes today, but also bolster your savings for the future.
We're talking with Randy and Jake at Floyd Financial Group, and we're talking about some ways that you can mess up your retirement if you're not careful. Our next one is putting it off. Now, I don't know about you, Randy, if you remember when President Eisenhower was in office. I was a little kid, maybe a toddler, and I asked my dad who the president was, and he said, well, it was Eisenhower. But President Eisenhower's famous phrase was important but not urgent. And I think a lot of people use that when it comes to saving for retirement. It's important, but it's not urgent. I'll do it tomorrow.
Yeah, the thing that I always take away from that, and I've heard that statement, is I always tell people we want to address things while they're important and not urgent, right?
Right.
We don't want to wait. Don't want to wait till urgency, right? It's really true. I mean, by starting just that little bit earlier, those final few years when you're looking at getting it, if it's a 10-year deal or a 12-year deal, and you can maybe get a double on your money or another at least half of what you got out there. I mean, when the numbers get larger later in life is where it really, really matters. But if you don't start early, the numbers don't get big enough to have as much meaning later.
Right. So don't put off saving for retirement, and don't consider that retirement is so far off into the future. The next one is overcomplicating retirement. Now, I remember a little bit that Bill Cosby used to do when I was a kid, and he talked about his financial advisor taking his money, and he goes, I turned it inside out, upside down, and I did all these sort of things in order for me to make more money. He made it sound like it is very, very complicated. Does retirement planning require that sort of complicated planning?
No, it doesn't. In fact, when you look at most of the 401k plans that you have and the 457s, if you work for a government or a municipality, or if you've got a thrift plan through the government, or whatever retirement plan you have, a simple IRA, all those sorts of things, they generally have built into them from, they have maybe 30, 40, maybe 50, 60. There's some that are more broad today, but they'll have a few investments out there, and they'll have those that are very conservative to those that could be pretty volatile depending on how you place that money. But it's not one of those things where you have to go out every day. And you may remember, Jeff, and I remember this, when we would look at a newspaper and you'd go to the market section, and there were pages, full newspaper pages of all the stocks and the offerings and the bonds out there, and people would sit there and pore over those things. And honestly, what they were doing there was they were chasing returns, and chasing returns, we know, is one thing that doesn't really work. And there was really not that much information out there. They were just looking, okay, so here's the ticker, and here's what it went up or down yesterday, and here's where it's been the last 3, 5, 7 years, that sort of thing. They could learn stuff from there, but as far as really making them smart about investing, I'm not sure that was the case. The one thing that we do know, over the long haul, you don't have to be in a very risky and very gambling-like position to make a good return in the market.
Right. And when I talk about not overcomplicating retirement planning, it's not something, again, I think that you can do yourself, because there is an advantage to the experience that you have. And certainly there are a lot of tools that you have available to you. But again, it just comes down to some basic tenets of what your money can do for you. And that is provide cash flow. It can provide security. It can grow. It can be liquid. And of course, it has tax savings. So again, at Floyd Financial Group, you guys have really broken it down into steps that can achieve all those goals. Our telephone number, 417-889-7233. We're talking with Randy and Jake of Floyd Financial Group about ways not to mess up your retirement. Let's squeeze this one in, guys, is chasing hot investments. I think that is one that I think a lot of people make the mistake of doing. They'll see something that seems to be hot, and boy, they're all over that at the expense of other things.
Absolutely.
Get you some of that crypto.
Yeah.
Well, the other one, we got to go all in on Rivian. Do you
that
remember Rivian?
What's Rivian?
So Rivian is an electric car company.
Yeah.
And about, what's it been, 18 months since they went public?
Yeah.
They opened, now get this, they opened at $100 billion in value, and they hadn't delivered one vehicle, which was more than the market cap and value of the big three automakers that have been in business since 1900.
Wow.
So
current market cap is $8.8 billion now.
Right,
from
exactly.
100.
So they've
and it
gone
went to 200 right after its IPO.
Yeah, for every IPO that we can go out and chase, and it goes up 1,000, 2,000, 4,000%, there's another 75 to 80 to 100 that don't. And so we have to really be careful. It's okay to chase something that you believe in, but do it with a small amount of money. If you make some money on it, take out your seed money, play with the house money.
I agree with you on that one. Well, I love those Rivian pickup trucks. I've seen them on the road, but I haven't seen that many of them on the road. So don't chase hot investments just because somebody says, hey, NVIDIA is the thing to get. Don't chase those. I think you really have to look under the hood a little bit to determine whether or not this investment is going to be right for you. Talking with Randy and Jake, Floyd Financial Group, and we're talking about ways that you can mess up your retirement savings if you're not careful. And we're going to continue this conversation in our next segment. In the meantime, if you like these guys, you like listening to the show, you want to have a chance to sit down with either one of them and have a casual conversation to get your questions answered, we're offering that for you right now. No cost for this. It's complimentary. Certainly there is no obligation whatsoever, and there is no judgment. We call it our Floyd Financial Group Retirement Review. You can get yours by calling 417-889-7233. It's that simple. 417-889-7233. Make that call this weekend. Leave your name, your telephone number. Ashley will call you back during the week and set you up with an appointment so you can sit down and have your own sort of little private radio show with these guys. Ask the questions that you need to put you on a path towards a confident retirement. Again, it's not going to cost you anything. Why wouldn't you make this call? 417-889-7233. You can also request your plan online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Time for a break. We'll be right back with the final portion of our show, Show Me the Money, right here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And continuing in this segment will be the 12 ways that you could possibly mess up your retirement. And let's just say no to drugs, right?
That's right. It is a good one to remember at all times, unless they're prescription drugs and your doctor has said you got to take these. But let's go on with number 9 here, and that is going to be chasing the market. Again, these are people who see, well, my mailman said he made some money with NVIDIA, so I got to chase that. What do you think about chasing the market? Could that be a way that you could mess up your retirement?
Well, I think so, because here's the thing. Many times I've heard people say, hey, I got a stock tip. Tell me about it, So the stock tips generally are public knowledge. And if they're not, you're really in trouble. We don't want to do that either, right?
Ask Martha Stewart.
Yeah, exactly. By the time things get around to that, of course, Nancy might have a different take on it, Pelosi, that is. But anyway,
okay.
Chasing returns, the thing that you have going on there most times is people are out looking at charts and things have done really well. In fact, case in point, I'll give you one. Some people listening to this program will remember this very well, because in the 90s and through a lot of the 2000s, the Magellan Fund was the hottest mutual fund out there. And Jeff, you may remember the Magellan Fund.
Oh, yeah, sure.
But here's what's interesting about it. Just as many people lost money as made money in the Magellan Fund over about a 25-year period. So as good as the Magellan Fund looked, and way back in the day, there was not the Iran-Contra, but there was the Contra Fund. And who had the Contra Fund? What company? There was I think it was Fidelity Contra Fund that everybody was getting into and everybody was talking about for the longest time. And you haven't heard about it in years now. So I guess what I'm saying is chasing returns. Generally what's happened is the market has run up, people have made some money, and now they're saying, man, this is just the be-all, end-all. You got to get in. And generally what's happening is you're now going to buy high, and you're going to go, wow, this was a mistake, and then you're going to sell low and look for the next one.
You're providing liquidity for the billionaires to get out.
Right, exactly. Well, when something runs up like this and it's really, really hot, is it too late? I mean, you're up there at the crest of the wave when you really should have been down when the wave was first starting.
So that's why you have to have a situation to where somebody is looking under the hood of investments and figuring out, is this in your best interest? I mean, I will just tell you, and we can show chart after chart after chart after chart after chart. I did that a whole lot of times because there's a lot of charts out there that we can talk about that show that target dated funds inside these 401k plans have just underperformed the general market over and over and over and over, with not much difference, especially in the last decade for sure, of market volatility, but always lagging the returns of the S&P.
We're talking with Randy and Jake at Floyd Financial Group about ways that you can mess up your retirement savings. Next one on the list, guys, is investing in cash instead of stocks because it's safer. Is that necessarily a way that you're going to mess up your retirement in today's environment? Because, you can get 5% returns sometimes.
I wouldn't say it's necessarily a way that you can mess it up, but yes, you can stay in cash too long. I know a guy that we talked with probably about a year ago, and the guy had managed to save up $400,000 or $500,000, but he did it without ever participating in the market past about 1989. And so had he had that money in the market, he'd have probably $2 or $3 million without too much trouble. I think it's important to take some risk. How much risk is very individual, and you need to understand your goals and your risk capacity and all that kind of thing. But I think the United States stock market is, as far as I know, the greatest wealth creation engine in the history of mankind. And so pretty much any metric you look at longer than about 6 months, you're going to come to that conclusion. And so I think having some money tied to that in some way is a good thing. Now, again, I'm not giving blanket advice. I'm not saying you need to take all your money and stick it in the stock market. I'm just saying that you get that growth and you have, to a large degree, liquidity inside the market to where you can buy and sell things, you can take income, you can do all those types of things. So as a retiree, the market can be attractive too because of its flexible nature.
Yeah, I think you need to have a balanced approach. And here what I mean by a balanced approach is this. Everybody's balanced approach is different. Now, in investing, there is this thing called a balanced portfolio. And believe it or not, Jeff, guess what that is? 50% stocks, 50% bonds. Yep. So it's 50% equity and 50% debt, right? Because that's what a bond is a debt.
Yeah.
So in its true form, that's a 50-50. That's a balanced allocation, we call it. Now, what's a balanced allocation for a client? I'm here to tell you that for a client, a balanced allocation is different for each one because everybody has a different capacity that we've talked about in the past for risk and their just ability to take it as well as their mental capacity to deal with volatility. But we need to have an approach, that gives people some additional options other than just one, right?
Right. And I have a friend who's a financial advisor as well, too. He had a client who came to him and she had been investing for many, many years, or I'll say investing in quotes, and she wondered why she couldn't retire and why her friends were all retiring and taking a look at her investments. I mean, they were in cash. She had not been in the market at all. So that was a big mistake, whereas she may have had $400,000 or $500,000. Her coworkers had, like $2 million. So investing in cash instead of the stock market because it's safer could be a way that you're derailing your retirement. Next one on the list is going to be holding too much in your own company's stock.
Yeah, that's a pretty good one there. So let's say, most of these companies today will give you an option, or the larger ones will, to buy company stock, sometimes with a stock option that lets you buy it back if market value. Or sometimes you can just buy stock inside what we would call a stock ownership program that you can fund with after-tax dollars and buy your own company stock. And that's great. If you believe in your company and you're working for that company and you believe it, that's great. I will caution people, though. We've had a local, pretty good-sized employer around here that has been a company, and I've driven by their building since I was a teenager. But of late, their stock has been the subject of, there's been lawsuits against the company and things of that nature that drove the stock down from up to as much as around a couple of $100 a share down to $80 and $90 a share. A lot of these people had a lot of that stock because they believed in the company. And if I told you the company, you go, well, yeah, I know that company and I would believe in that company too, but things happen and you need somebody at the wheel watching what's going on. And again, just because you work there doesn't mean it's the be-all, end-all, right? It's good to do a good job for your company and believe in it. Don't get me wrong. Companies are just companies, and as my dad used to say, every dog has its day.
And some dogs' days come sooner than others. We're talking about the ways that you can mess up your retirement savings with Randy and Jake of Floyd Financial Group. We're down to the last one, gentlemen, and that is not having any kind of a retirement plan. I think this is the biggest mistake of all.
Yeah, again, I want to take the onus of this off of people, if you will, because many times we just don't do a good job of educating people. And many times, too, when the 401k representative comes in that one time per year to, execute their fiduciary duty, and having been there and done it when I worked in my corporate job, meaning, hey, we're going to have a meeting and talk about the 401k and your options, and I'm like, I'm going to go play golf.
Yeah.
And I didn't show up.
Right.
So was it my fault or the financial advisor's fault or the company's fault? Of course, it was mine because I wasn't taking enough interest in it at that point in time. So all I would do is I'd want to plant a seed with people today. If you're not taking advantage of somebody's time to help you plan for retirement, you should be. And, if you're within 10 years of retirement, now's the time to really get after it and really start nailing down things and really looking at how you're investing, looking at paying off debt, all those different things. Give us a call. Let's sit down and let's talk. If you're within 5 years, you need to put the finishing touches on there. We need to put the bow on top. So let's go ahead and get together there and visit about that as well. And as you've alluded to many times on here, Jeff, it's a conversation.
Right.
It's a learning experience. We will learn about you and what's important to you. You will learn about us and how we look at things and how we see people and their retirements. And it's just a really good conversation, very relaxed. We'll drink coffee. If you don't drink coffee, we have soft drinks and all sorts of things here. But we'll just get to know you and have a good conversation. I promise you'll feel good about it when you leave.
So for our listeners, if you're hearing this program today, you do not have a retirement plan, you're wondering where you can get it, well, 417-889-7233. That is your opportunity to sit down with Randy and Jake and talk about your financial future and your retirement. Again, it's not going to cost you anything at all. There is no obligation. You can always say no. Nobody's going to put the thumb down on you and say, when are you going to come with us? No, it's a casual conversation with people who are just like you, who want to help you succeed when it comes to retirement. Again, that telephone number to call to take advantage of this opportunity today, 417-889-7233, 417-889-7233. You can also request your plan online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. So, Randy and Jake, a little more time left in the program today. I want to talk about some highly effective habits of retirees. I think the first one is one that people really don't think about and neglect a lot, and that is living with a sense of urgency every day.
Yeah, for sure. As a guy gets older and you've been on the planet a little bit longer, you realize that, hey, you know what? Our days are numbered.
Right. No one's promised
tomorrow.
Here. Yeah.
But the long and the short of it is, we want to all live life and we're always looking to that day, right? To where, hey, we get to retirement. We don't have to punch the time clock anymore. We don't have to drive the roads anymore. And we don't have to be out there in rush hour traffic and all that sort of thing. So let's think about really where we are today and let's create this sense of urgency to get yourself to a point to where you can live the way you want to live in retirement, whether that's 20 years from now, 10 years from now, 5 years from now. Let's make sure that we're living with that importance today so it's not urgent tomorrow.
Right, and I will add this to it too. Don't live in the past and don't live in the future. I mean, you should live in the future to the extent that you're really looking into the future as far as planning goes, but try to live in the present and enjoy every day as if it's your last. Next one is you got to take some risks. I understand without risks, there very likely will not be a reward.
Well, that's really true. I mean, you've got to take a little risk, but you got to take a measured risk. And so that's why it's really important that you sit down with somebody that can really guide you through your process. And your process is different than anybody else's. And I don't care what anyone says, there's no blanket solution. So we have to sit down with people, get to know them, know what's important to them, see where they are in the scheme of things right now, getting toward retirement and toward the end of their working career, and put together a plan that makes sense for them. But it does usually come with taking a little bit of risk, but we're not going to gamble. Like Jake said, we're not just gambling with money. We're not going out there and put it all on Black 17 and hoping that it's an IPO like Rivian that goes to $200 billion and stays there. We want to make sure we put some thought into it and we really know what the calculated risks are that we're taking.
Habits of highly effective retirees. Our next one on the list is going to be being healthy. Now, in 1900, the leading causes of death were influenza and tuberculosis. Today, it's heart disease, cancer, and stroke. I think that really says something about our degree of activity in today's world.
It does. The one thing that I would say for all people listening to this, but especially for us folks that have been on the planet a few decades longer than some of the other ones, is, staying active and keeping moving and going and keeping a social community around you and being able to visit with people and have interaction with your kids and family is very important. And you got to keep going. We see people that come home and retire and they sit down and they don't do anything. And pretty soon they either can't do anything or they're no longer with us, Jeff. So we want to be sure that we focus on pursuing something that we like. Everybody probably on this show knows that I love to swim, bike, run, play golf, and fish.
Right.
So, and then of course, my family and my grandson here that's local now, Trevor.
Right.
We're going to do some bike riding this summer, and I'm going to take him fishing, and we're going to play some golf. So important.
Yeah, and you've retired to something, not from something. I mean, you've been a financial advisor. I think you'll always be a financial advisor to some extent, but you retired to this great lifestyle, which includes some physical activity, and hats off to you. Next one is you want to retire on your bank account, not necessarily your birth date. I think a lot of people get that backwards.
That's for sure, because if the bank account is empty, retirement's not going to be very enjoyable.
Yeah, that's
I'll
right.
just tell you right now, because the bills still come every 30 days at my house. And so we have to have some income for that. Again, for some people, they're going to work till they're 70. For other people, they can't wait to get out when they're 60, or we have some people even in their late 50s that are retiring. Everybody's a little bit different, but at the end of the day, income, the size of your bank account, your retirement account is going to determine just how much and how soon you can retire and how much you'll have when you do.
We've been talking about habits of highly effective retirees, and the last one on the list here is to foster meaningful relationships.
For sure. Again, I alluded to that a little bit earlier. Nobody wants to go home and sit down and be alone, I don't think. I think it's important that you stay active, in the community. And if you are in church, that you have a church membership and some people that you can visit with there. But it's important to have a lot of social interaction. For the longest time, as I was in my career and I worked, for 50 years full time, I still work here, as you know, part time.
Right.
Jake runs day-to-day operations. He's been working here 18 years. This is, really, other than in college when he was, working and doing some part-time stuff, this is the only career he's really ever known. And of course, Elizabeth, his wife's been here going on 18 years. But I have learned that as I have slowed down here, that my relationships outside of business are very important to me. And what's really kind of cool is with me working here part-time, I get to keep some of the relationships that I built during all those working years. And so everybody kind of becomes like family, if you will.
And I think no great victory in life is worth very much unless you have somebody to share it with.
Exactly.
And that goes for a spouse or family members or friends and, like you said, church, that kind of thing. So I agree with that 100%.
We've been talking about habits of successful retirees with Randy and Jake of Floyd Financial Group. Once again, our telephone number, 417-889-7233. If you'd like to sit down, have your private conversation with Randy and Jake, 417-889-7233, totally complimentary. And, of course, no judgment whatsoever and no obligation. Well, gentlemen, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners here, the last bastion of sanity, Springfield, Missouri. So for Randy and Jake, I'm Jeff Shade. Have a great weekend. We'll talk again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.